Part of the Australian retirement income system is the compulsory superannuation scheme, generally referred to as super, where an employer makes regular compulsory super contribution payments on behalf of an employee for average weekly ordinary time earnings. Laws passed in 2012 introduced by Labor meant the compulsory super contribution rate would gradually rise to 12% by 2025. However, the Liberal government has previously postponed several rate increases, and there has been a recent campaign from some within the Liberal Party to cancel the increases moving forward. This will likely cause key Labor members and industry lobby groups to create a vocal campaign around the Liberal government's true intent. The government's decision not to proceed with the rate rise is likely in part due to a Treasury report released in late 2020 which supported evidence an increase in the super guarantee would result in lower wages growth impacting the current standard of living, while the same report also highlighted removing the guarantee would reduce the lifetime disposable income across all income groups. In substitute, it suggested individuals significantly boost their retirement income in ways other than increasing the super guarantee, including using account savings more efficiently, placing financial responsibility back on the individual. In a recent poll undertaken by Industry Super Australia, 71% of respondents supported the super guarantee increase and believed scrapping the guarantee in favour of a wage increase was seen as a tax grab by the current government. So is there enough evidence to support the super guarantee increase to 12% be cancelled in favour of increasing wages, or is there more to it? This video seeks to identify the concerns around the expected super balance approaching retirement and whether the contributions into super based on the current rate of 9.5% is still suitable for building up a retirement nest egg. The Australian retirement income system is based upon three pillars: a means-tested age pension, compulsory superannuation, and voluntary savings, including home ownership. The Australian retirement income system needs to support a standard of living through providing adequate retirement incomes in a sustainable and measured way. It is also important to ensure the system is fiscally sustainable and provides appropriate incentives for self-provision in retirement. Simply put, the superannuation system is designed to reduce pressure on the government-funded age pension scheme. As part of the retirement income system, the Australian government introduced mandatory super in 1992 to help every working Australian support themselves in retirement through compulsory super contributions. Since its inception, the mandatory super contribution rate, often referred to as the super guarantee, has increased from 3% to 9.5%, with a gradual increase to 12% by 2025. Since most people tend to only focus on short-term needs, without a compulsory savings scheme such as super, many Australians would save less for retirement than required to maintain a standard of living that meets expected consumption needs, adding further pressure to the government-funded age pension. There is a general consensus within government suggesting the existing super guarantee rate, currently at 9.5%, is sustainable and future super guarantee rate increases are not necessary and should instead be awarded in wage increases. Proposing the expected super guarantee increase should be given to workers in the form of wages may benefit some Australians who are struggling given the challenges associated with the current COVID-19 economic environment. The debate surrounding such changes is difficult to determine given the super guarantee rises are already legislated, while there is no current legislation to force employers to increase wages. To assume Australian workers are better off paid in the form of a wage supplement or in a super guarantee really comes down to two competing factors: the consumption needs of today in the form of wages and the expectations of future consumption in retirement, which is super. There may be some individuals across different income levels who are financially struggling, and a potential wage increase would be beneficial to meet their current consumption needs. Guaranteeing a cash payment made in the form of wages less the marginal tax rate can help individuals support themselves today instead of waiting until retirement. If, however, the current consumption needs are relatively stable and the individual is able to contribute towards super, they will experience the tax advantages and compounding returns that the super system is known for. Super payments tend to be taxed at a discounted fixed rate of around 15% compared to the marginal income tax rate, and are also subject to compounding investment returns through ongoing management within the super fund. In context, a person earning an annual income of $60,000 would be paying 32.5% tax on their income, while super guarantee payments are generally taxed at a fixed rate of 15% up to the annualised concessional contributions cap. To determine whether the super guarantee increase is more appropriately paid as super or in a wage supplement requires some calculating. So for now, some arbitrary datasets have been chosen which best represent current market and employment conditions. For these calculations, it is assumed the nominal inflation rate is 1.61%, a dynamic marginal tax rate applies to income exceeding the tax-free threshold currently at $18,200, a fixed super rate of 15%, and a conservative annualised super return of 6.5% applies to these like-for-like comparisons. An Australian worker earning an annual gross income of $60,000 with an additional 2% in wage supplements would pocket an extra $979.06 for the year after tax. When comparing this to the super guarantee, an increase of 2% would generate $1,086.30 net of taxes. In this example, the worker would experience a gain of $107.24 or 10.95% when electing to have the 2% paid into super for the year when compared to the wage supplement during the same time frame. In another example, the legislated super guarantee increases commence from July 2021 with an annual rate rise of 0.5% to a maximum of 12% by 2025. If an Australian worker starts a career in 2021 on an annual gross income of $60,000 and has a nominal annual salary increase of 2.2% for the next 30 years, the cumulative effect of the super guarantee rate rise paid as a wage supplement would total $29,110.21 net of taxes. The super fund gains both a tax benefit and a compounding benefit when compared against wages. When factoring for annualised super returns at 6.5%, total returns included by the super guarantee rate rise is valued at $83,692 over 30 years, an increase of $54,581 or a 187.5% greater return than the wage payment over the same time frame. One of the arguments in the Retirement Income Review Treasury Report is that a similar return could be made without increasing the super guarantee rate simply by achieving better after-fee returns. Online investment advisory service StockSpot outlined in its recent annual report the top performing super funds and the worst performing super funds across 4 different fund portfolios, based on a 5-year average investment return. Comparing the data from StockSpot on the top 10 performing funds against the bottom 10 performing funds in each category, the greatest variance in the aggressive growth fund was 8.4%, while it was 7.4% for growth funds, 9.1% for balanced funds, and 4.1% across moderate super funds. The median result for the same comparison on aggressive growth funds was 5.3%, 4.4% for growth funds, 3.1% for balanced funds, and 2.6% for moderate funds. Super fund performance has a significant impact on long-term super returns, although it is still important to acknowledge past performance is not an indication of future performance. This analysis does not cover all circumstances and does not factor in admin fees or charges, however it does demonstrate the possibility of improved super returns when comparing super fund performance. While not every Australian would be in the top performing or worst performing super fund, the analysis from the StockSpot report does support a hypothesis a boost of even 2% in super funds can be achieved by changing super fund providers. This should not be taken as a direct like-for-like comparison in terms of investment returns and a super guarantee, particularly for individuals whose super fund already carries a balance. An increase of 2% on investment returns on an existing balance is not the same as a 2% increase in incoming payments from a super guarantee based on an individual's salary over their working career. It is reasonable to assume the government is trying to strike a balance on tax revenue versus benefits for workers now and into retirement. Increasing the super guarantee rate has several tax implications for the government, such as income taxes, including Medicare levy, when contributions are made to a super fund, when investments in a super fund earn income, and when super benefits are paid out. Other costs impacting tax revenue include low income tax offsets, the age pension and supplemental costs, and franking credits claimed within retirement accounts. In a 2020 study published by the Australian National University, researchers attempted to answer the questions surrounding the tax revenue implications created by a super guarantee rate increase from 9.5% to 12%. The model suggested the lifetime tax implication per person was between $12,000 and $47,000 and was less for higher income earners. In another study conducted on behalf of Industry Super Australia, maintaining the super guarantee at 9.5% would increase the cost of the government-funded age pension by as much as $33 billion to a total cost of $98.6 billion by 2058. Another key indicator for the Liberal government's decision to consider withholding the super guarantee increase was the concept of reverse mortgaging and drawing equity from the home, a debt which is repaid on the sale of the estate. In cases where retirees do not have sufficient savings to support themselves, the suggestion to sell the family home to afford a more comfortable retirement affects the financial security afforded with home ownership. Home ownership plays a significant role in determining financial security in retirement, and relying on reverse mortgaging is an especially high-risk policy initiative when home ownership has been steadily declining over the last 50 years. Between 1971 and 2016, home ownership among the 25 to 34 year age group fell from 57% to 44.6% and fell from 71.4% to 62.2% amongst the 35 to 44 year age group. Any type of policy encouraging young home buyers to sacrifice retirement savings to enter the housing market is likely to create significant problems on fiscal budgets in the future, as individuals struggle to save enough in super to cover their retirement costs, putting pressure on the government-funded age pension. Do note, however, that the current Liberal government has not made a firm commitment against the super guarantee, and it is still likely to proceed with current legislation promoting a gradual increase from 9.5% to 12% between 2021 and 2025. While there is some speculation the super guarantee increases would be funded by employer profits, it is widely perceived that higher contributions are ultimately funded by lower wages, which leads to a lower standard of living. Such concerns were raised in the Department of Treasury report, which advocated for increased wages growth over increasing the super guarantee. One of the challenges the Liberal government will have in withholding the already legislated super guarantee will be in convincing Australians the rate rise will be turned into a guaranteed wage increase. There are currently no laws being introduced to guarantee a universal annual wage increase that matches the super guarantee rate increase. Many unions and Labor would likely oppose any such changes without some evidence wage increases will be legislated in Parliament as a substitute for lost superannuation. There are also concerns these changes will be a repeat of the Liberal government's 2017 laws which reduced weekend and public holiday penalty rates. The objective of the decision made by the Productivity Commission at the time was this would create more jobs, yet studies have found there has been no new jobs created as a result of the laws. In fact, some industries have gone backwards as a result of the changes, whilst at the same time, working Australians have experienced permanent reduction in take-home wages. Given the many contradictions between the evidence and a telling report commissioned by the Australian government themselves, it should come as no surprise they continue to advocate for maintaining the super guarantee at 9.5%. There are some unusual assumptions made in the report which certainly raise some concerns. Expecting workers and retirees to be more efficient with their savings is not exactly leading social policy, especially with rising consumer prices. Neither is the suggestion retirees sell their one financial asset that provides them security, which would then be sold to pay off the debt rather than the traditional transfer of wealth as a bequest to their children. Because of the tax benefits in the superannuation system, as well as a compounding effect on investment returns, Australian workers would be better off overall if the government proceeded with the super guarantee increase to 12% over the next 4 years. The financial benefit of increasing super provided a significant increase in expected retirement wealth when compared to increasing annual wages. Some of the data analysed supports government advice that small changes such as changing to a better performing and lower cost super fund can still provide the financial gains likened to the legislated super guarantee increase without imposing further financial risk on struggling businesses. And while this is great advice, it should not be a substitute for additional super payments. However, without new laws to ensure wage increases will at least match the super guarantee in the event of withholding rate increases, many Australians may get caught out losing both future wages growth and a super guarantee rate increase, providing little support for the standard of living both now and into retirement.